Welcome to How to Retire on Time, a show that answers your questions about, well, all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon or by going to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can pretty much discuss whatever's on your mind. Now, that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. With me in the studio today is my esteemed colleague, Mr. David Franson. David, how you doing today?
I'm well. How are you?
I'm doing well.
Great.
This is going to be a good show. And now, just for the newcomers, this is how the show works. David will be reading your questions, and I will do my best to answer them. You can send your questions in by either texting them to 913-363-1234, that's 913-363-1234, or email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, I've never been invested in real estate. I keep hearing about how it is such a great investment. Is it? If it is, what's the best way to invest in it?
Yeah, this is going to be a fun one. So, real estate is an uncorrelated market. That's the first thing to understand. So when we look at diversification, it's kind of nice to have uncorrelated markets. And if I had to define it, I think there's roughly 5 markets out there. If we're going to define it specifically, you've got, and this is from like a financial advisor suitability definition, but you've got your cash and cash equivalents. So your CDs, your money markets, your checking savings, high yield savings. You've got the bond market, treasuries, corporate bonds, all of that. You've got the equities market, so your stocks specifically, and these are all uncorrelated, by the way. So a lot of people have bond funds. They think they're inverse correlated. So if stocks go down, bonds go up. That's not always true. They're separate. They're uncorrelated. Then you've got your insurance market. And I say the insurance market because it can offer you different benefits and detriments than other markets. Like a fixed indexed annuity is a very different way to potentially grow money and hedge against risk than an equities strategy would look like. Then you've also got the alternative space. The alternative space, you're then dealing into the more of the abstract. This is the partnerships. This is the real estate. This is, everything else. It's the grab bag. And so within that, there's different categories. But real estate market is an uncorrelated market to all of these other ones. So the stock market can do whatever it's doing. The bond market can do whatever it's doing. The real estate market is going to do whatever it's doing.
Okay.
They can all go down at the same time. They can all go up at the same time. And they can also go in different directions at the same time.
That's where the uncorrelated comes in?
They are just their own thing.
Okay.
So you don't want to say, well, I'm trying to hedge against a market crash, so I'm going to buy real estate because when markets crash, real estate's going to go up. That would be an inaccurate statement to say. So that all said, this is a reason why many people will invest in real estate, is because they want uncorrelated markets to just kind of have I don't want to say broad diversification in a way that Charlie Munger had put it, and we said that earlier, the overgeneralization that's just saying, I want a little bit of everything just for the sake of having a little bit of everything. You can be very deliberate in your equities strategy, your bond strategy, and your real estate strategy. Like a sniper, you're dialed into a very specific objective. You can do that with real estate. However, you need to understand the different ways that you can invest in it. Me personally, I'm not telling you need to do what I do. I do not personally invest today in real estate. I'm not opposed to it in the future, but I'm more focused on more aggressive growth personally. Real estate is just a different beast. Now, later on in my life, I will probably incorporate real estate. So I want to be very open and transparent. What I do is different than what you're going to do. I don't personally invest in real estate right now based on my lifestyle and legacy plan today.
Yeah.
You may want it though. So here are the different ways that you can invest in real estate. You got your real estate investment trusts, and there's 2 categories there. You've got the publicly traded REITs or real estate investment trust, or you have the private real estate investment trust. Be careful about publicly traded REITs.
Yeah, tell us why.
the reason is because they're publicly traded, they can have liquidity issues, as in they have to keep a lot of cash on hand for when people want to sell them. If you have more cash within a trust, you're not making as much money. And a lot of these publicly traded REITs, in my opinion, have antiquated, older, just assets in their portfolio. It's not as competitive. And so you can't have your cake and eat it too. Publicly traded REITs, I find to be less competitive than privately traded REITs. When it comes to real estate, you don't want a lot of liquidity. Where do you want your money? You want it growing. You want it in assets that can do something for you. So if you do a privately traded REIT, you're going to have liquidity issues, but they're going to be able to take then more money because they're restricting the liquidity for a certain period of time, and they're putting it into very specific real estate investments.
Okay, makes sense.
So that you can potentially get a better dividend, you can have potentially better growth, so that it could have more potential of a better experience. But you've got to be almost like a CPA and do your due diligence on the accounting, on the market research, and get very specific with it. Because just like a CD today, you might get around 5%. You can also get 0.5%. Privately traded REITs can be wonderful and they can be terrible. It's the due diligence. I do not recommend that people buy privately traded REITs from the company that's offering the REIT themselves. You almost, and I say almost because there are no such thing as absolutes, but you almost want someone who's a professional to vet it for you.
Okay.
It's like when you buy a used car, you take it to the mechanic, say, all right, is this car a lemon or is it legit? Privately traded REITs, get a third party to vet it for you.
I see.
If you don't know how to do the vetting yourself. So that's the REIT category. Then you've got your real estate itself. So whether you're a landlord with residential real estate, you're a commercial real estate investor, that's another way to get into it, which we could do a whole show on just real estate investing, which would be a lot of fun.
Yeah.
But you got to understand the exit strategy. And so as you do real estate investment, like in the actual physical asset, you'll probably enjoy depreciating the asset down. But once you want to sell it, if you have a fully depreciated asset, which means the cost basis is zero at that point, everything is taxable. So you need to understand your exit strategies like Delaware Statutory Trusts, for example. And that's a whole nother topic unto itself. But those are kind of the two ways that I see people enjoying real estate.
Yeah.
It's not for everyone, and that's okay. So don't feel pressured to do it because everyone else is doing it. That's a cognitive distortion to do what everyone else is doing. Do what's right for you. But, have some fun with it. And when it comes to real estate, ignore the YouTubers. Please, please, please. The TikTokers, the YouTubers, the things that are out there. Because I'm hearing things like, well, we're going to buy a property and it's negative cash flow, but that's okay because we're going to depreciate the asset. The depreciation offsets the... No, those are highly leveraged situations. Or they're riskier situations. That doesn't make sense. When you go into real estate, you want positive cash flow.
Yeah.
Maybe you put money up front into it to then turn it into positive cash flow. But if you're going into real estate, make sure you're going towards positive cash flow. There are many TikTokers, YouTubers that are also talking about the Airbnb. This is an actual thing I heard recently. I couldn't believe it. They're going to say, well, go on Zillow and find some sort of person that's had a rental property up for a long period of time, but just haven't been able to find a tenant for whatever reason, and say, hey, I'll do it. I'll manage it. I'll take care of everything, but I'm going to use that as an Airbnb, but I'll cover it, I'll insure it and all that stuff and negotiate with them. And let's say the person says, okay. And then it says, now go out and then find someone to clean it up, find some place to rent a furniture to furnish it, find some place to then clean it. So you're adding up cost and all these different costs. Okay. And then you're supposed to just magically, consistently get people renting from it for short-term rentals. It can work, but there's an incredible amount of seasonality when it comes to Airbnb. And if the markets were to crash, you've got a long-term rental contract. No one's traveling. And if inflation's an issue, people aren't going to travel as much. I mean, look back at the last couple of years and see how many people were actually traveling. Forget the COVID restrictions.
Yeah.
If people can't afford to travel, who's taking you up on your Airbnb option? So there's no such thing as a perfect investment product or strategy. If it seems too good to be true, it is. You want consistent, dependable, positive cash flow in real estate. Don't over leverage yourself. Take too much debt, which is risk. And don't listen to these YouTubers, TikTokers who think that they have quote unquote hacked the system or found a secret.
Sure.
There are no secrets. If it were that easy, Wall Street would be doing it and beat you out of the market.
Uh-huh.
And a lot of the times I've found that they'll say, well, I made 200,000 or 300,000. That's the gross revenue usually. They're not including their expenses, their taxes. Sometimes they are, but usually I'm noticing the overgeneralized claim to keep people excited. And if it worked so well, why are they selling a course for $50 to teach other people how to do this? They're saying, hey, pay me $50 and I'll train you to be my competition. Like the whole thing just smells and reeks of deception.
Right.
So again, real estate, a wonderful investment in uncorrelated market. No problem if you want to get into it. Just make sure positive cash flow if you want REITs. So you're going to put a certain amount of money in there. Consider privately traded REITs over publicly traded REITs. If you want to actually be a landlord, understand, maybe get into a smaller resident first, test it out, get the experience, and then slowly add to your portfolio. Be careful out there. There's risks associated with every strategy. There's nothing perfect out there. Now, that's all the time we have for today. If you want more tips about retirement, income, taxes, Social Security, healthcare, and more, make sure you subscribe to this show wherever you get your podcast. Just search for How to Retire on Time. Also, you can catch this show via our 24/7 digital broadcast by going to www.retireontimeradio.com. You can stream various episodes on your phone while you're on the go, in the car, or wherever you are on a run. Just go to www.retireontimeradio.com. From everyone here at Kedrick Studios, thank you for spending your time, your most precious asset, with us today.